Expanding on our recent YouTube video, I want to highlight the stark contrast between how banks handle unrealized losses and the approach taken by asset-based lenders like us. Today I'm focusing on note receivables as a specific case. In order to give a true picture, I need to briefly touch upon the impact of rising interest rates on a bank's asset portfolio, particularly concerning government securities. My perspective is that these securities, despite being a staple in bank portfolios, must be reevaluated in light of current market conditions. With the upswing in interest rates, there is a critical need for banks to adjust the valuation of their government securities to mirror their present market value. This value, in the context of increasing rates, is likely lower than what is currently reported on their balance sheets. This discrepancy between the acquisition cost and the current market value is significant and cannot be overlooked. Banks typically hold a substantial portion of their assets in government securities. As interest rates rise, the market value of these securities often declines due to the inverse relationship between interest rates and bond prices. This decline should be accurately reflected in the bank's financial statements to present a true and fair view of their financial position. In essence, for a realistic assessment of a bank's financial health, it's essential to align the recorded value of their government securities with their actual market value in the current interest rate environment. This adjustment is more than a mere accounting practice. It's a reflection of financial prudence and integrity in reporting, ensuring that the bank's asset portfolio is evaluated correctly in the context of market dynamics. When dealing with non-performing notes, asset-based lenders adopt a distinctly different strategy compared to banks. Banks have the luxury of leveraging their non-performing assets, borrowing against them through government-backed institutions. This mechanism allows them to temporarily mask unrealized losses, essentially concealing the true state of their finances. For asset-based lenders, our approach is more straightforward and transparent. We actively work to offload such assets to regain liquidity and ensure continued asset performance. Our survival amidst market fluctuations hinges on establishing robust equity positions against our assets. We prioritize maintaining liquidity through effective portfolio management, minimizing unrealized losses by leveraging our equity positions and swiftly converting non-performing assets into cash. We view with skepticism income statements that inflate profits with paper income, earnings that don't accurately reflect the financial reality. Relying on borrowing against unrealized losses, assets that would incur a loss if sold, is akin to walking the tightrope without a safety net. Reminiscent of scenarios like Enron, where the illusion of financial stability is eventually shattered. In an economy increasingly driven by fiat currency, this tunnel vision approach adopted by banks seems even more precarious, akin to a house of cards, rather than a sustainable financial model grounded in actual profitability and accurate asset valuation. Short-term paper profits, clouded by unrealized losses, are a recipe for market instability. At Fulford, we commit to staying rooted in tangible, sustainable economic practices. Our focus is on maintaining liquidity that supports genuine investors, navigating through impending market storms with a firm grasp on real-world economies, not just paper values. Our approach ensures that we continue to provide a stable, reliable financial foundation for our clients and the broader market. With that said, this has been Nathaniel with Fulford Lending. Thank you for watching.